Hi, this is Mark Thomas from tradeontrack.com. Today we're discussing a fractal-based trailing stop strategy that's being developed for winnersedgetrading.com. So visit that site for an accompanying article which describes the strategy in more detail. This is the first article and video in a series, and we'll just discuss the overall concepts of how this trailing stop strategy may work. Now, fractals, whether you've heard about them or not, are fairly simple. On a chart, a fractal is basically a turning point in price. So a down fractal is defined as a point where you have a low and two higher lows on each side of the candle. So here we have a low, and on the left hand side we have a higher low and another higher low, and on the right hand side we have a higher low and another higher low. And for an up fractal, or what I've termed a bearish fractal in the article, we have a high, and on each side we have a lower high, and on the right hand side lower high, lower high. So that forms a fractal here. Using the MetaTrader platform in this example, and if you look on the indicators list on the left hand side, you can't see it here, but you'll see a fractals indicator which you can just drag onto the chart and it will automatically draw these little arrows for you. You've probably got a similar thing on other trading platforms as well. So that just helps you quickly see where the fractals are. Now in this example we're looking at the pound chief 15-minute chart over the last day or so. This is on Friday, and this is where we finished up on Friday night or Saturday morning my time, and we had a nice down move here where we could have caught quite a few pips. So we're going to take this as an example. Quite often the way you can use fractals is to enter a trade, not just for positioning stop losses, but to enter the trade as well, usually in conjunction with some other sort of indicator, for instance a moving average. Now we have a down fractal here, or a bullish fractal. The reason it's called a bullish fractal is because it's often used as a turning point. If price moves back up this way, then it's moving in a bullish way away from that turning point. And the up fractals are termed bearish fractals because they're often a turning point where price will turn back down and keep going. So let's say we enter our trade when price breaks through this level, which is our down fractal, which would have happened on this candle right here. So it's broken through this level. So the first thing we define in our trailing stop strategy is that we'll position our stop above the last bearish fractal or up fractal prior to this candle where it broke through, or our entry candle in this case. So this is our entry candle. It happens to be a fractal, but at the time this candle was drawn, we didn't know it would be a fractal. We don't know that until after two more candles have closed, which hasn't happened at this point obviously. So our stop loss is going to be positioned just above this fractal point, so probably about here. So price moves on down, forms another bullish fractal here, comes up, forms a bearish fractal. We haven't moved our stop loss yet. Price comes back down and breaks this level here, which is our last bullish fractal. So it breaks it on this candle. So our rules for our trailing stop strategy are to move the stop loss to just above the last bearish fractal. So what will happen is we'll move our stop loss to about this level here, which is just above the last bearish fractal. Alright, so our initial stop was here. After we broke through, we'll be moving our stop down to here. Alright, so price goes down, makes a bearish fractal there, continues on down again, breaks through the last bullish fractal at this point. So once again our rules are to move the stop to just above the last bearish fractal, which would have been just here. Now if you remember, that's where we had our stop anyway, so we don't actually move our stop in this case. Price continues, breaks through the last bullish fractal again on this candle, so we move our stop to just above the last bearish fractal, so we'd move our stop to about here. Now we need to be careful, we need to build in a little bit of a buffer between the high of the candle and where we actually put the stop, because we get instances here where we get a bit of a fake breakthrough, but it doesn't last and it continues on down. So the difference in prices here between this high and this high is only 1 or 2 pips. So if we allowed, say, 5 pips above the high of the candle to where we put our stop, then we would have stayed safe all the way through here. So recapping, once price breaks through this level going down, we move our stop to here. Price would have come right up to here, just right next to the stop, but not taken it out. Then continues down again. On this candle here, it breaks through the last bullish fractal, so our rules are to move the stop to just above the last bearish fractal, which would have been here. Now we already had it here and it would have gone up a couple of pips. Now our rules should also be that we don't move our stop further away. We only ever move it down if we're in a short trade. So our stop would have remained at this point, wouldn't have moved. Comes down, forms a bullish fractal at this point, comes back up, doesn't continue on down, it doesn't break through this last bullish fractal. So our stop is still here. Then what happens is price comes up, turns back down and forms another bearish fractal at this point. Now here's where our last rule comes into play. We've got a fractal formed here which is higher than the last bearish fractal. Okay, so as soon as we've got this candle after, that's the first candle after this fractal, and the second candle, as soon as that one is closed, then we know we have a fractal. So right when we get to here, our rule states that we should move the stop loss to just above that last bearish fractal. So our stop would be positioned here. Okay, and price comes up and would have taken out our stop loss right there. So we've caught a decent part of that downtrend. We got in about here, went down to here, and we got taken out. Our trailing stop got taken out about here. So we caught a decent part of that move, and that's often the way it will happen. It's quite a good system in its own right, this trailing stop strategy. So in the next article and video, we'll cover how we can convert this design or strategy into some programming code. Thank you.